Is in turmoil once again, with investors wondering how a government shutdown can affect their money. That's what we're digging into on today's Stocks in Translation. A shutdown happens when Congress misses a budget or a short-term fix. Essential services keep running, but many others pause as most federal workers are temporarily let go or furloughed. So let's break down what a government shutdown is and is not. First, it's a temporary funding lapse. It slows some services, and it can delay many data releases, like the monthly jobs report we're supposed to get this Friday. It can also delay federal permits and loan approvals. Just as important, here's what a shutdown is not. It isn't a government default on debt. Also, stocks and bond markets do not close. And essential services like law enforcement, transportation, Social Security payments, they keep on going. It's not the end of the world, but it can cause inconveniences. In the late 2018 shutdown that went on for a record 35 days, the SEC was unable to process paperwork, and that delayed both the Uber and Lyft IPOs by months. Now let's take a look at the actual market impact of the 11 U.S. shutdowns since they became a thing in 1980. We're going to start with stocks measuring the S&P 500. Here, each bar represents the median return for a different time period. And for the first two bars, they are the week prior and the day prior to the shutdown. And for after the shutdown, we look at the performance: 1 day, 1 week, 1 to 3 months, and 1 year following the shutdown date. And as you can see, the median returns, which are kind of like an average, they're pretty small until you get up to about a month after. We did see some pretty big reactions to the downside leading in the week of 1982, 84, and 2018, but the shorter time frames do not produce clear trends. But even in 2018, when the government shutdown went on for over a month, stocks were positive after a short initial drop. Translation: markets tend to look past the noise once the funding headlines fade. Now let's take a look at the long end of the yield curve, the U.S. 10-year Treasury note yield, which mortgages across America are tied to. Much like stocks, when you put all the results together and take the median, we don't see big changes in the week prior to the week after the shutdown. We did, however, see some big outliers in many years. So it's not like bond yields didn't react the week prior and after. There's just not a predictable historical pattern over the entire set. But once you start looking 1, 2, 3 months after the drop, you see consistent drops in long-term yields. In 9 out of 11 times, rates dropped 1 month after the shutdown started, with a median drop of 19 basis points, or about 0.2%. Finally, we also took a look at short-term movements in U.S. rates, which admittedly tend to move around Federal Reserve policy more than anything else. Once again, we see lots of big and small moves, both to the upside and the downside, from 1 week prior to 3 months after, which don't really produce any big trends. However, 1 year later, we do see some drops in short-term rates about 2/3 of the time, with a median drop of 39 basis points. Here's the roll-up. Stocks tend to be flat around the start of shutdowns. Then they climb higher 1 to 3 months out. But remember that stocks also tend to go up, so that's a big tailwind. For bonds, long-term yields tend to drift lower over 1 to 3 months, and short-term rates are mixed until they skew lower at about the 1 year mark. And here's what to keep an eye on. First, the continuing resolution path. That is a quick off-ramp to avoid or end a shutdown. 2, length matters. The longer the standoff, the more it can nick growth expectations and pull long-term rates even lower. 3, data delays. If reports slip, markets lean harder on data that's not coming from Uncle Sam. And finally, we do see spillover effects as federal contracts, small business loans, and travel and park areas, they can all feel the stoppage. Wrapping it up, shutdowns are politics loud and markets quiet unless they last.